Hello and welcome to the Investing on the Go podcast, brought to you by FundCalibre. I'm Darius McDermott, and today we're joined by Martin Lau, elite-rated manager of the First State Greater China Growth Fund. Martin, thank you for your time.
Thank you, Darius.
You've been manager on the fund since 2003, and you will have learned, I'm sure, a lot. There will have been a lot of changes in the marketplace in China. Can you give us a brief summary of some of the major things that have changed at a market conditions level since you began running this fund?
Yeah, that's a very good question, Darius. Thanks a lot for having me. Well, I think I've been managing this Greater China Fund since 2003. So it's been like 16 years, and I've been running China funds for like 25 years. I think one of the major thing, which has been quite rewarding over the years, is that we've seen a significant increase in depth for the China stock market, and that was actually before the China Asia market even opened up. If you think about some of the top Chinese companies that we are talking about today, like Alibaba, Tencent, or some of the really leading technology companies, these companies were actually just founded 20 years ago and listed, give and take 5 or 10 years ago, except Tencent. But then, since over the last 15 years, we've seen a significant increase in the market depth, in the number of companies that investors like us can choose from. And as bottom-up investors like us at First State, this is actually a very important thing. And the second thing, which alongside with that, is actually the opening up of this Asia market. Asia market, as you probably know, is actually the second largest stock market globally, with $8 trillion market cap.
Huge, isn't it?
Yeah, and nearly 4,000 listed on the market. So again, these days, on average, like once every 2 or 3 weeks, we'll be visiting different parts of China, seeing a number of different Asia companies. And in our view, that is going to be extremely important in generating performance over the next 10 years. We believe among these nearly 4,000 companies, there are some really good ones, and we believe we can be a long-term shareholders of. Excellent.
With your style, which investors have enjoyed for a long time, good corporate governance has always been something which you and your team have looked for. How easy is it to find good corporate governance, and has that actually changed and improved over the last 10 plus years?
Yes, corporate governance is an area that we focus a lot, and I would say corporate governance has definitely improved over the last 10 years. In terms of the absolute corporate governance, you still cannot compare against the Western standard of corporate governance, ABC 1, 2, 3 type of standard. One major difficulty when it comes to corporate governance in China is the state ownership. 70-80% or more of the companies are still owned by the government. So just like in Britain, maybe in the past, British Telecom, BP, etc., whenever government owns a stake in a company, there's a natural misalignment of interest between the government and you as a minority shareholder. So we do have that. What we've learned over the years is that even state-owned companies, there are some good corporate governance, well-managed state-owned companies with a strong franchise. So state-owned ownership is not necessarily ideal. But even among state ownership companies, we still can find some good ones. The opposite of the spectrum is, of course, people talk about VIE structure. It may not be for the internet companies. You may not have the actual ownership of the underlying business for those internet companies. But again, something which we've learned over the years is, VIE structure is one structure, but even among the different VIE structures, there are different arrangements. So it's a bit simplistic to say that they are all bad.
They're all bad, yeah.
So it's a learning experience for all of us, and our intention or plan is actually to identify those companies with good quality management, which we can travel with, as in they would continue to improve their corporate governance. They may not be ideal as of today, but they're making improvements.
One of the key things in the Greater China Growth Fund, which I've always really liked, was your ability to invest in Taiwan and Hong Kong. There was always times in markets where you're just likely as a manager to be less cautious. And I think you've always pointed it to Taiwan and Hong Kong as sort of more defensive markets. Is that something is that actually true? And how much do you use those markets?
Yes, that's actually very true. There is the the way that we look at it is, China in a bigger form is actually, Taiwan wouldn't like this comment, but Taiwan and Hong Kong included as if we want a greater China economy. What actually happened within those three markets is because they are under slightly different liquidity cycles. So at times, for example, the China A-shares market last year was the worst performing. And this year, A-shares was actually the best performing, whereas Hong Kong market sometimes when it might perform better when interest rate expectation was that interest rate would fall. And Taiwan is an export-oriented economy, so whenever people are positive about external demand, it might perform better. So by combining the three together, we managed to maneuver around the different kind of extremes in different market and diversify out the risk for the portfolio. And also, if you take a long-term view, which we certainly do, the three markets are actually very different. China market is known for its big domestic demand, domestic market. There are lots of emerging technologies within China, like internet companies, so that's very unique for China, and also the large number of companies on the A-shares. In Taiwan, we do have quite a number of leading technology companies like TSMC. We are shareholders of Advantech and Delta Electronics. These are good quality companies. They tend to export. So again, Taiwan is quite unique in terms of export versus domestic consumption on the A-shares. And Hong Kong, again, is different. It's in slightly more established kind of companies like AIA Group, like Cheung Kong, etc. But Hong Kong stands out in terms of the business practices. And also some companies in Hong Kong, they manage to replicate their successful business model from Hong Kong to China, like Hong Kong and China Gas, which we've been a shareholder for many years, and Vitasoy, which is the soya milk company in Hong Kong, which managed to expand into China, and now China accounts for 2/3 of the profit. So we like this kind of like successful business model proven in Hong Kong and trying to replicate that into China.
Yeah, and we've touched briefly on China A-shares and corporate governance, but the A-shares are being now included in more of the MSCI global indices. Is that making a difference, and how much of your Greater China Fund do you commit to the A-share market?
Yes, that's a good question. In terms of the amount of time that we have committed to the A-shares is actually very, very significant. So all my team members, myself included, we actually spent more than half, I would say, of our time looking at and discussing A-share market, A-share companies. We may not have that amount of money invested into the A-shares because normally it takes some time for us to convince ourselves on the corporate governance, on the quality, etc. So if you look at the Greater China Growth Fund, as of today, is about 13% of the fund is invested into the A-share market. In total, as a team, we have about $2 billion US dollar invested into the A-share market, and that's out of 25 billion asset that we are managing as of today. So again, it's a growing market, it's an important market. We are probably devoting more than half of our time within China onto A-shares, but it will take time for us to get the confidence. It is a market which is rewarding. I mean, the number of companies that are available on the A-shares is just amazing. I mean, the amount of excitement cannot be more if you identify and say, for example, an entrepreneur that is really capable, that we can really believe in, and that they have a sound business plan, and you can see a lot of potential in 10 years' time. I mean, that's really, really exciting.
It would be amiss to have somebody of your experience and local knowledge with us today and not raise the subject of the US-China trade tensions, trade wars, however we like to call them. How are you seeing that impact actually on the ground with either companies that you're invested in or companies that you might invest in, and or is that just more of a noise that we see on the news, or is it actually impacting on the ground? Yeah, well, yes. Actually, I mean, the trade war, we believe, is a huge subject, and we also believe it is going to be something which would last for many, many years. It depends on the dinner between Trump or Xi Jinping or whatever. Sometimes it can be better, sometimes it can be worse. But our view is that this is going to be this relates to two big economies with different kind of value systems and having a conflict. It may be Huawei today, maybe technology, maybe trade, maybe import tariff. It may be something else tomorrow. So we believe the conflict is not going to go away anytime soon. At the moment, it's having. That's quite interesting because Trump meets with President. They walk out smiling. Markets are rally. The other times when the deadlines run out and he tweets something, and then markets can be quite violent across the globe. So you think this is a multi-year story.
Yeah, I think this is a multi-year risk that we need to accept. And we actually look back to Japan and what happened in Japan since 1989. The same thing kind of happened. Japan was a very strong economy then, and there were a lot of conflicts between the Japanese and also the Americans at that time. The way that we look at it is, first of all, it's clearly negative for the economy. So when you have two largest economies of the world trying to fight against each other, it's bad for global economy. And we've seen that with global growth, and we've seen that with bond yields. People expect the economy is going to weaken further. And it's also important for companies, if you operate out from China. I mean, I do have a lot of friends who run factories, etc. The amount of uncertainty that this has introduced, and you don't even know what tariff is going to be introduced anytime soon, and you just defer.
It's holding back
the
capital spending,
and you don't.
Whilst that uncertainty remains.
Yeah, and also especially bad for capex, capital investments, and also very bad for smaller companies, because you tend to have one or two customers, and if that one or two customers are not sure whether they want to place the orders, it's going to affect your whole business. So and therefore you might have seen the second quarter GDP was the weakest in like 27 years, 6.2%. We're seeing the same thing with automobile sales, with retail sales, with truck sales, and a lot of those are already happening. So I think our underlying case for China, even though we've been saying this for the last 15, 20 years, is that China's growth slowdown is structural. I think the trade war is going to make that happen maybe even sooner.
Great. Martin, thank you very much for your time and your comments. Thank you very much for listening. I'm Darius McDermott, and if you'd like more information on the Investing on the Go podcast, please subscribe to FundCalibre. Please remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.